Hello, everyone, and welcome back to Synaptic Investing. Hope you're having a fantastic week and are ready for another deep dive. It is Friday, February 13th, 2026, and we have a really fascinating session lined up for you today. Today, we are breaking down one of the most interesting companies on the market, the global leader in vehicle salvage and online auctions, Copart, Inc. Now, I know what you might be thinking, junkyards, really. We're going to spend an hour talking about rusted metal and smashed bumpers, but stick with me here because Copart is not just a company. It is this fascinating intersection of physical logistics, massive real estate holdings, and high-tech digital marketplace dynamics. On the surface, it looks like a standard industrial stock, a place where wrecked cars go to die, a very, very unsexy business. But the real question for us as long-term investors is this. Is this a mature, low-growth business that's just destined for stagnation? Or is the market ignoring a hidden monopoly with just a massive runway ahead? Are there cracks in the fortress, or is this the ultimate buying opportunity? That's what we're here to find out.
That's a huge topic. And before we dive deep, a quick heads up for the audience.
Right. If you're looking to invest, we use Interactive Brokers. Use the link in the description for a stock bonus when you sign up.
It's the best way to get a bonus and support the channel at the same time.
And while you're there, please like, subscribe, and let us know your questions in the comments.
Now let's get into it. Pillar number 1, the business model.
Okay, let's unpack this. Because when most people hear Copart, if they've heard of it at all, they picture a muddy lot with a bunch of smashed up Toyotas and Fords. Like a scene from a movie where the mob crushes a car. And physically, that is what you see if you drive past one of their locations. But we need to look under the hood, pun intended. What is the actual mechanism here? Because they aren't just selling scrap metal by the pound, are they?
No, not at all. And that is the biggest misconception that new investors have. If you view Copart as just a junkyard, you completely miss the entire economic engine. It's much, much better to think of it as a black box of value recovery.
A black box.
Yeah. So at its core, Copart operates a two-sided digital auction marketplace. The platform is called VB3. They are the connector, the bridge.
Two-sided, meaning buyers and sellers.
Exactly. On one side, you have the sellers, and these are primarily insurance companies. Think Geico, Progressive, State Farm, but you also have charities, fleet operators, rental car companies.
Okay.
They all have the same problem, a damaged asset that they need to liquidate, and they need to do it quickly.
Right, because an insurance company definitely doesn't want a garage full of smashed cars. They are in the business of writing checks, not fixing fenders.
Precisely. They want that liability off their books immediately. So on the other side of the equation, you have a global network of buyers.
And this is where it gets interesting.
This is where it's fascinating. We aren't just talking about a guy looking for a spare door for his '98 Honda. We are talking about professional dismantlers, rebuilders, used car dealers, and exporters from all over the world.
Okay, so Copart sits in the middle. But how hands-on are they? I mean, do they own the cars that are on their lots?
Generally, no. Copart is an agent. They take physical possession of the vehicle, they tow it to their yard, they store it on their land, but the transaction itself happens digitally on their platform.
Got it.
And the beauty of the model, the part that makes investors, drool, is that they generate revenue by collecting transaction fees from both sides of the trade.
Wait, hold on. They charge both sides.
They do.
That feels, well, it feels a bit greedy, doesn't it? Why do the participants put up with that? I mean, usually in a transaction, one side pays the fee.
It's the power of the platform. They charge the insurer a fee to process, tow, and sell the car. That's for the service of liquidity.
Okay, that makes sense.
But they also charge the buyer a significant fee, often hundreds of dollars per car, for the privilege of buying it. It effectively functions as a toll road for totaled cars.
A toll road. I like that.
And the reason the buyers pay it is simple. Access. Copart has the supply. If you want the inventory, you pay the toll.
I see. So if I'm a mechanic in, say, Poland, and I need a specific engine for a Mercedes, Copart is the only place I can reliably find, 50 of them in one day.
That's a great example. Let's actually trace that path because it really explains the buyer's side, which is often overlooked.
Out to that.
Imagine a 2024 BMW gets into a moderate accident in New Jersey. The airbags deploy. In the U.S., labor rates are, what, $150 or $200 an hour?
At least, yeah.
So repairing that BMW might cost $30,000 here.
Yeah.
The insurance company totals it.
Right, it's just not worth fixing in the United States.
But in Poland or Nigeria or Mexico, labor might be $20 an hour. Or maybe even $10.
So the math changes completely.
Completely. That same BMW, which is considered trash in New Jersey, is a gold mine in Warsaw. A rebuilder can buy it on Copart for $10,000, ship it, fix it for maybe $5,000 in labor and parts, and then sell it for $25,000. There is a massive arbitrage opportunity, and that is why the buyers are willing to pay Copart's fees. Copart is essentially exporting U.S. deflation in the form of crash cars to markets where they can be reinflated with cheap labor.
That is a fascinating way to look at it. They're not just a junkyard, they are arbitrage enablers.
That's the business.
But I want to touch on the resilience of this business. I mean, we've been through some pretty wild economic swings over the last few years. Inflation, labor shortages, fluctuating gas prices, running these massive yards that requires people, loaders, massive amounts of diesel fuel. Their costs must have gone through the roof.
You would think so. And you're right, yard operational costs and labor inflation have risen significantly over the last 3 years. If Copart were a standard commodity business, their margins would have been absolutely crushed. We've seen this with other logistics companies. Revenue goes up, but costs go up faster, and profits just shrink.
Right, the profitless prosperity trap. You're busy, but you're not making any more money.
But look at Copart's data. They have maintained robust operating margins of around 37%.
37%.
Yep, and gross margins near 45%.
37% operating margins.
Yeah.
For a business that involves tow trucks and mud, that is frankly unheard of. That's software territory. Adobe has margins like that, not a logistics company.
It is exceptional. It's a complete anomaly in the industrial world. And what it tells us is that Copart has successfully passed on every single cent of inflation to its user base without seeing a degradation in volume.
So their fee structure, it's just proven to be inelastic.
Completely. When they raise prices to cover the cost of diesel or driver wages, the insurers don't leave. The buyers don't leave.
Because they can't.
Exactly, because there's nowhere else to go.
Wow.
The business is essentially a cash machine that is structurally insulated from the cost pressures that kill normal industrial companies. They have pricing power that most CEOs only dream of.
So we have a cash machine. But a cash machine is only good if no one else can build one right next to it. If I see you making 37% margins, I'm going to want to start the Deep Dive Salvage Co. and undercut you. This brings us to my favorite part of any analysis, the moat. And for Copart, we have to talk about the Lollapalooza effect.
I love that term. It's a Charlie Munger classic.
Rest in peace to the legend.
Absolutely. A Lollapalooza effect is when you have multiple forces, psychological, structural, economic, all pushing in the same direction at the same time. The result isn't just linear, 1 + 1 = 2.
It's exponential.
It's nonlinear geometric convergence. It's 1 + 1 + 1 = 10. And Copart is the physical embodiment of this concept.
Let's break down those forces then.
Yeah.
What are the specific pillars creating this effect for Copart?
The first, and maybe the most powerful, is the network effect. Specifically, something called Metcalfe's law.
Okay, stop there. Metcalfe's law sounds like something from a physics textbook. Break that down for us in simple terms.
It's actually from telecommunications. It states that the value of a network is proportional to the square of the number of connected users.
Okay.
In plain English, the more people who use it, the exponentially more valuable it gets for everyone. So Copart has the most buyers globally.
The biggest network.
Right. And because they have the most buyers, they generate the highest liquidity. And that gets the best prices for the sellers, the insurance companies.
Okay, so if I'm State Farm, I want to sell my car where the most bidders are because that competition drives the price up.
Correct. And because the insurers get the best returns at Copart, they give Copart more cars. More cars attract even more buyers because now the inventory is deeper and more diverse.
It's a self-reinforcing flywheel.
It's the perfect flywheel.
It's the classic chicken and egg problem that so many platforms face, but they've solved it. If I'm an insurance company, why would I send my total Tesla to Steve's auction house down the street where there might only be 3 local bidders?
Right.
When I can send it to Copart and have 3,000 bidders from 100 different countries fighting over it.
You wouldn't. In fact, you could argue you have a fiduciary duty to your shareholders to minimize your loss severity. You have to send it to the place that gets the highest bid. Copart wins simply by being the biggest.
But there's a physical constraint here, right?
Yeah.
You can't just host these auctions on a server in the cloud. You need land. A lot of land.
And that is the second force, scale economies. Copart owns massive real estate footprints. We're talking about thousands and thousands of acres.
That's a huge fixed cost.
It is, but it allows them to distribute those high fixed costs, the technology, the cranes, the gate staff, over immense vehicle volumes. A smaller competitor with just 1 or 2 yards. They can't possibly compete on a per-unit cost basis.
And that leads perfectly into what I think is the most unique part of this story.
Yeah.
We usually talk about moats, but here we have something I like to call the anti-moat. It sounds negative, but it's actually a huge positive for the incumbent.
You're referring to the zoning laws and NIMBYisms?
Not in my backyard.
Right. Think about it. Try to go to a city council meeting in, say, London or Los Angeles or even a growing suburb of Dallas today.
Oh, I can just imagine.
Walk in there and propose building a new 200-acre salvage yard. Tell them you're going to store thousands of wrecked, leaking vehicles that might catch fire or leak oil into the groundwater.
Oh, man. They'd laugh you out of the room. Or throw tomatoes. The residents would absolutely riot. Think of the property values. Think of the children.
Precisely. It is effectively politically impossible to obtain new zoning permits for this kind of industrial activity near major metropolitan areas.
And that's key near the cities.
That's the critical part. That is where the accidents happen, where the people are. You need the yard to be near the city to keep towing costs down.
So Copart is sitting on land that they bought 20 or 30 years ago when those suburbs were just cornfields.
Correct. They engaged in what's called land banking. This makes Copart's existing owned real estate portfolio a cornered resource. It's not just an asset on the balance sheet. It is a fortress. The land they own legally and physically prevents competitors from replicating the network. You can have all the software in the world, you can have a better website than Copart, but if you don't have the permitted land within 30 miles of the city center to store the cars, you cannot compete. Period.
That is such a powerful concept. The government is essentially acting as Copart's bodyguard, stopping new entrants at the door because they refuse to issue new permits. That is a moat filled with bureaucratic alligators.
It really is.
But there's also a softer side to this moat, right? It's not just about the hard assets like land and the network effects. There's a sticky relationship with the insurers.
Yes, this is the soft power aspect. Copart isn't just a vendor that they call up. They are deeply integrated into the workflow.
How so?
They have proprietary dispatch and title processing software that is embedded deeply into the insurance company's IT systems.
So it's not just a person at Geico calling a tow truck.
Far from it. It's all automated. When a claim is filed at Geico, the data flows directly into Copart's system. Copart's system dispatches the truck, it processes the title with the DMV, it sets the auction date.
So to switch to a competitor like their main rival IAA.
To switch to IAA, an insurer would have to rip out that entire integration, and that creates severe switching costs.
Switching costs is one of those business school terms.
Yeah.
Give me the reality. What does that actually feel like for the insurance company?
The reality is pain. It's just immense organizational pain. We're talking about procedural friction, retraining thousands of claims adjusters on a new system, rewriting code, and risking massive data loss during the transition.
It sounds like a nightmare.
It is. The pain of leaving is so immense that even if a competitor offers a slightly lower fee, say $10 less per car, it's not worth the operational risk and the headache.
It's not worth the brain damage.
Exactly. Retention among top carriers is structurally rigid because of this integration. Once Copart is in your system, they are like a parasitic vine. In a good way, for the shareholder. You just can't pull them out without damaging the host.
It sounds like an impenetrable fortress. But I want to play devil's advocate for a second. We always need to look at the culture and the management. If we go on Glassdoor right now, the reviews for Copart are, well, let's be honest, they aren't great. We're seeing averages somewhere between 2.4 and 2.8 stars.
They're low.
People are complaining about long hours, working in the rain, stress from management. Is this a red flag? Is there rot inside the company? Because usually when I see a 2.4-star rating, I run for the hills.
It's a fair question, and it's one we must take seriously. We never want to invest in a company that abuses its staff.
Yep.
But we have to look at the context here. This is the inside view. What are the complaints actually about? If you read them closely, they're about the nature of the work itself. This is blue-collar logistics. It is outdoor work. If it's raining, you're working in the rain. If it's snowing, you are in the snow. If it's 100 degrees in Texas, you are sweating inside a loader.
So you're saying this isn't necessarily a toxic culture, it's just a really hard job.
Exactly. Low scores driven by things like it's hot in the summer or the hours are long during hurricane season are standard for the logistics and waste management industries. Compare it to waste management or a big trucking company, and the scores are very similar.
Okay, that's important context.
It does not signal a rot in the corporate strategy or the engineering culture. Now, if we saw complaints about accounting fraud or sexual harassment or strategic confusion like management doesn't know what they're doing, that would be a huge sell signal.
Of course.
But complaints about the weather, that's just the reality of the business.
That makes sense. It's not a Google campus with nap pods and free lattes. It's a salvage yard.
Right.
Now, let's look at the people at the very top, the CEO's report card. The Willis family has been running this for a long time. How are they treating our capital as shareholders?
This is where Copart really shines. If you look at the numbers, the capital allocation is just elite.
Elite. That's a strong word.
It is. They have a TTM return on equity of around 18%. But more importantly, they have zero long-term debt. We call this a fortress balance sheet.
Zero debt in 2026. After the interest rate hikes we saw a few years ago, that is incredibly rare.
It is. Most industrial companies loaded up on cheap debt in the early 2020s. Copart didn't. And this gives them immense optionality. If the economy crashes, they don't have to worry about interest payments. They can go on the offensive while everyone else is playing defense.
So what do they do with all the cash they generate? How do they spend it?
Their deployment hierarchy is very, very disciplined. Priority number one is always organic reinvestment, buying more land.
Back to the cornered resource.
Always back to land. They know that land is the ultimate source of their moat, so they buy it whenever they can, often years before they even need it.
Okay, what's priority two?
Priority number two is opportunistic buybacks, but only when the stock price is dislocated.
So they aren't just buying back stock to pump the price every single quarter, regardless of valuation.
No, they're price sensitive. They act like long-term investors, not short-term cheerleaders. And priority number three, and this is so key, is the avoidance of diversification.
Diversification. I love that Peter Lynch term.
It's the silent killer of so many great companies and their returns. They don't buy random businesses. You won't see Copart buying a car wash chain or some software startup that has nothing to do with salvage just because they have cash burning a hole in their pocket.
They stay in their lane.
They stay in their lane. This discipline is why their return on invested capital drastically exceeds their cost of capital year after year. They are value creators, pure and simple.
That discipline is so refreshing. We see so many CEOs get bored and try to build an empire, only to destroy shareholder value in the process. Copart just keeps buying dirt and crushing cars.
And it works.
I want to pivot to the financials, specifically the quality of earnings. We hear a lot about EBITDA and adjusted numbers in the market today. How clean are Copart's profits?
This is a critical test for any company we look at. We need to do what we call a SBC reality check, stock-based compensation.
Okay, break this down for me. I see stock-based compensation on income statements all the time. Why is it a bad thing? Isn't it good to align employees with the stock?
Ideally, yes. But in the tech world especially, it's often used to hide real costs.
How so?
Imagine we run a lemonade stand. We sell lemonade for $100 and it costs $80 in lemons and sugar to make. We made $20 in profit, right?
Right.
But instead of paying you $10 in cash for your work, I give you $10 worth of shares in the stand. Then I go report to the world. Look, my cash expenses were only $70. I made $30 in profit. But I didn't. I just diluted the other shareholders to pay you. That is what many tech companies do with adjusted EBITDA.
Ah, so they are paying salaries with printer ink, just printing new shares instead of with cash from the register.
Exactly. It's a real expense and it dilutes your ownership slice of the pie. But look at Copart. Their stock-based compensation is approximately $38 million. Okay. That sounds like a lot until you compare it to their operating cash flow, which is around $1.8 billion. That represents an exceptionally low, something like 2.1% of OCF.
2.1%. That is practically a rounding error compared to some of the tech names we look at where it could be 20, 30, even 40%.
It is pristine. It means the earnings are real. They're not playing accounting games. Shareholder value is being actively protected.
And what about cash flow?
On top of that, they're free cash flow conversion. So how much of that accounting profit actually hits the bank account as cold, hard cash comfortably clears the 80% threshold? That is the gold standard. This is a highly efficient economic engine that generates real distributable cash.
So we have a fortress business, great management, and clean financials. But investing is about the future, not the past. Let's talk growth. And this is where it gets really interesting because it involves the paradox of electric vehicles and modern technology. This is the part that I think confuses people the most.
This is the most debated part of the entire thesis, and we have to apply second-level thinking here.
Okay, let's start with first-level thinking. The fear. What is the market afraid of?
The first-level thought is simple and intuitive. Cars are getting safer. We have ADAS advanced driver assistance systems.
Right, the automatic braking, lane keeping, all that stuff.
Collision avoidance. If cars don't crash, Copart has no volume. If there are no accidents, there are no totaled cars. Therefore, Copart is a dying business.
That logic seems pretty sound on the surface. If the car stops itself, it doesn't hit the tree. If it doesn't hit the tree, it doesn't go to the junkyard. Simple.
But that's where second-level thinking comes in. We have to look at what happens when a car does have an accident, even a minor one. Modern vehicles, especially EVs like Teslas, are essentially computers on wheels.
Right.
They are packed with sensors, cameras, LiDARs, and of course, massive complex battery packs.
So a fender bender isn't just a fender bender anymore.
Precisely. In the old days, if you dented a bumper on a 2005 Ford Taurus, you hammered it out, sprayed some paint on it for a few $100 and kept driving. Cost? Maybe $500?
Yeah.
Today, a minor collision on the front bumper of an EV might destroy a whole suite of ADS sensors, crack the radar housing, and maybe compromise the cooling system for the battery tray. The repair bill is suddenly thousands and thousands of dollars.
And let's not forget Giga casting.
Right, a huge point. Tesla and other OEMs are moving to Giga casting, where the entire front or rear of the car is cast as a single giant piece of aluminum.
Great for manufacturing efficiency.
Fantastic for manufacturing, terrible for repairability. If you crack that casting, you can't just cut out the bad piece and weld in a new one. The structural integrity is gone. You have to replace the whole frame.
No, a minor crack totals the car.
Yes. The cost to repair becomes higher than the value of the car, and the liability for the OEM is massive. If they repair it wrong and the battery catches fire a month later, they're liable for millions. So the insurance companies are just saying, forget it, total it.
Do we have numbers on this, or is this just a theory?
We have hard data.
Yeah.
The total loss frequency, so the percentage of accidents that result in a car being scrapped, is skyrocketing. It hit roughly 22.6% in 2025. That is up from about 15% just a decade ago. Think about that. Even if the total number of accidents drops slightly because of safety tech, the percentage of those accidents that result in a total loss is rising structurally.
That is a massive shift. So fewer crashes, perhaps, but way more cars from those crashes ending up in Copart's yards because they're just too expensive to fix.
Exactly. And this just fuels the flywheel we talked about earlier.
It's so.
Because these aren't just heaps of scrap metal anymore. These are high-value wrecks. A totaled EV has valuable battery materials, lithium, cobalt, nickel. It has rare earth magnets in the motors. It has pristine interior parts, computer chips that are in high demand.
So it attracts more specialized buyers.
Yes. More specialized buyers globally who want those specific parts.
So the wreck itself is worth more, which means the buyers bid more for it, which means the insurance company gets a bigger check back, which means they love Copart even more.
Correct. Higher complexity equals higher scrap value. It is the computer on wheels thesis. Complexity is Copart's best friend.
Now, looking ahead 5 or 10 years, there's another phase to this story. You mentioned earlier that their number one priority is buying land. But what happens when they run out of places to buy? What happens when they have a yard in every major city in America and Europe?
This is what we call the Cannibal phase transition. Right now, Copart is still in growth mode, buying land in the US and Europe. But eventually, the US and UK markets will approach physical saturation. They will have all the land they need.
At that point, the reinvestment needs will just drop off a cliff.
Exactly. They won't need to spend billions on dirt anymore because they already own it all.
Okay.
But the cash machine will still be running. In fact, it will be running faster because they aren't spending on acquisitions and capex. So what happens? You have this massive free cash flow generation and nowhere to spend it on growth projects.
What do they do with the cash?
If management stays disciplined, and we believe they will, Copart is perfectly positioned to become a cannibal.
A cannibal? That sounds terrifying.
It's a term in finance for a company that aggressively eats itself by buying back its own stock. If they start pouring that excess cash into share buybacks, they can reduce the share count significantly over time.
Explain the math on that for the listeners. Why is reducing the share count good for me as an investor?
Imagine a pizza cut into 8 slices. You own 1 slice. If the company uses its cash to buy back 4 of those slices and just throws them away, there are now only 4 slices left.
Okay.
Your 1 slice is now 25% of the company instead of 12.5%. You own double the percentage of the company without spending a dime.
And that boosts earnings per share because the same amount of profit is divided by fewer shares.
Yes. This acts as a turbocharger for EPS growth. Even if net income grows at a boring 10%, your EPS could grow at 15% or 20% because the denominator, the number of shares, is shrinking every year.
This is how mature companies like AutoZone or O'Reilly Automotive have delivered monster returns for decades.
Exactly. Copart is just now entering that phase.
So we get a double whammy: structural growth from total loss frequency, and then accelerated earnings growth from buybacks. That sounds like a recipe for a compounder.
It is.
But we have to talk about price. Is it too late? Today is February 13, 2026. The stock is trading at $37. What's the valuation look like?
Let's look at it. At $37, Copart is trading at roughly 18.5 times forward PE. Now, for context, over the last 5 years, its historical average PE has been around 32.4x.
Ooh! That is a massive compression. It's trading at almost half its historical multiple.
Yeah.
Why? What's the market thinking?
The market's wager is that Copart is now a mature, low-growth industrial. The market believes that the post-pandemic normalization of used car prices and a temporary dip in insurance claims will permanently stunt growth.
So they're pricing it like a steel mill, not a platform monopoly.
That's a perfect way to put it. They think the glory days are over.
So the market thinks the party is over. But if our thesis holds that total loss frequency is a structural tailwind and the moat is fully intact, then this is a mispricing.
It is a profound mispricing. Let's triangulate the intrinsic value using a few different methods.
Okay.
Method A, we can call it mean reversion. If the stock simply goes back to its historical average multiple of 32 times PE on the consensus earnings of $2 per share,
The stock should be.
the stock should be at $64.80.
That's nearly a double from where it is today.
Now, that's optimistic. So let's look at Method B, Wall Street consensus. The average target from sell-side analysts is around $48.50.
Okay, still significant upside.
And Method C, if we run our own conservative DCF, a discounted cash flow model, assuming just 10-12% growth, not the 15-20% they've done historically, we get a value of roughly $47.60.
Let's do a reverse DCF. I always like that as a reality check. What level of growth is the current price of $37 implying?
At $37 a share, the market is pricing in roughly 6% to 7% growth forever.
6%. That seems incredibly low. I mean, inflation alone is half of that.
Exactly. You are paying for 6% growth in a business that has historically grown at 15% and has a massive structural tailwind from EV complexity.
So all three methods point to a value significantly higher than $37.
They do. The intrinsic value clusters firmly in the high $40 to low $50. At $37, we are deep in the buy zone. We have a genuine margin of safety. You are buying $1 of value for 75 cents, and you're buying a monopoly asset to boot.
That sounds compelling. But we are not cheerleaders here. We are analysts. We need to do a pre-mortem. How does this investment kill us? I want you to put on your red team hat. Be the bear. Scare me. What breaks this thesis?
Challenge accepted. The first risk is one we touched on earlier: technological obsolescence. What if we were wrong about the accident rate? What if autonomous driving works perfectly?
The God mode scenario where cars just don't crash.
Yes. If we reach a point where software is flawless and accidents drop to near zero, Copart's volume evaporates. It doesn't matter how high the total loss frequency is if there are zero crashes. If cars never hit each other, there is no salvage industry.
That's the existential threat. Though I'd argue we are a long, long way from flawless autonomy in a blizzard in Minnesota.
True. But technology moves fast. A more immediate risk is cyclical deflation.
Okay, what does that mean?
Copart's fees are partly tied to the value of the cars they sell. If global used car prices crash, say, due to a deep recession, or if scrap metal prices plummet, the transaction fees they earn per vehicle will compress. We could see a period of earnings stagnation or even decline, even if volume is steady.
And that's the value trap argument, that the 18.5x multiple is justified because earnings are about to shrink for a few years.
Correct. But there is one more risk, what I'd call the ultimate threat. This is a long-term structural risk over the next 10 years, and it's the OEM closed loop.
The Tesla scenario.
Yes. Imagine if Tesla or BYD or Toyota decides to create their own recycling ecosystem. Instead of letting the insurance company option the totaled car on Copart, the OEM says, no, we want that car back.
Why would they do that?
Because they want to harvest their own batteries, their own proprietary chips. They want to keep that technology in a closed loop out of the hands of third-party repair shops and foreign competitors.
So they would bypass the auction entirely.
Exactly. If the OEMs successfully monopolize the insurance and recycling of their own vehicles, like Tesla Insurance is attempting to do, they could cut off Copart's supply. This would be a structural impairment to the business model.
And that's the one thing that could bypass the zoning mode.
Because the OEMs would likely have the political capital to build their own recycling facilities.
That is definitely something to watch closely. If we see Tesla launching a massive internal recycling division that takes all their crashed cars back, that's a major warning flare.
It is. But as of today, February 13th, 2026, Copart is still the most efficient way for the entire industry to liquidate these assets. No one else has the network liquidity.
So let's wrap this up with a final synthesis. Where do we land on this?
Quality score, high. It passes all our filters, inversion, moat, financials, management. It's a very high-quality business.
And valuation.
Valuation score, cheap. This is a rare opportunity to buy a high-quality compounder at a discount to its intrinsic value.
It really does feel like one of those moments where the market is looking one way at the short-term noise, and the long-term data is pointing in a completely different direction. I want to leave you with a final thought today. We spend so much time looking for the next AI miracle stock. We chase the shiny objects, the flying cars, the quantum computing breakthroughs. But sometimes, the greatest wealth is built in the places nobody wants to look in, the scrapyards, the mud, and the boring zoning meetings. Copart owns the dirt that the rest of the automotive world needs to stand on. And in a world of digital, ephemeral assets, there's something incredibly powerful about owning the physical bottleneck.
Well said. Perfect summary.
Remember, none of this is financial advice. Please check the disclaimer, do your own research, and read those 10Ks. Thanks for listening to Synaptic Investing. We'll see you in the next deep dive.
Goodbye, everyone.